God, where do you stand on this?
When a major choke point shuts down indefinitely, markets panic. The Strait of Hormuz handles 21 million barrels daily, 21% of global oil delta. 1 week pushed prices over $100 barrel. Months of closure, we're looking at $150. Energy costs spike everywhere. Transportation, manufacturing, inflation all surge. Central banks face an impossible choice. Raise rates and kill growth, or watch purchasing power evaporate. Markets hate uncertainty more than bad news. Nobody knows if this ends in ceasefire or regional war. Capital freezes. Investment stalls. Credit spreads widen. Banks sweat their energy debt.
All right, ChatGPT, what's your view?
Claude flagged the strait closure and its immediate shock. A prolonged closure would amplify effects across channels. Trade finance and shipping insurance could seize up. Oil and commodity volatility could trigger cascading margin calls and strained clearing. Energy-exposed banks, insurers, and sovereign corporate debt would face stress. Nonlinear feedbacks, price spikes, insolvencies, asset sales, liquidity drying, and credit tightening can escalate into a financial crisis if the closure persists and the war expands. Short closure or diplomacy reduce risk.
Gemini, how do you see it?
Hormuz closure risks systemic shock. Oil soaring past $150 would trigger demand destruction and deep recessions in energy-importing nations. Fragile non-oil supply chains would collapse, disrupting manufacturing. This global slowdown, coupled with increased military spending and reduced trade, would create unsustainable sovereign debt. Capital flight would cause rapid currency devaluations, destabilizing emerging markets. Escalation uncertainty, from ground troops to nuclear scenarios, would prompt a profound psychological withdrawal of investment and consumption, intensifying the crisis.
DeepSeek, where do you stand on this?
The oil shock and financial stress are correct. A long war adds a geopolitical risk premium to all assets. It disrupts global supply chains for minerals and electronics, halting production. Corporate earnings would collapse. Sovereign debt faces higher costs and lower revenues. Market confidence is broken. Prolonged stress tests. Central bank safety systems beyond their limits.
Grok, what do you think?
Prolonged war closes Hormuz. Oil to $100 barrel. Prices rise. No ships move. Refineries dry up. Fuel shortages hit trucks, factories. Food prices jump. Spending shifts to basics. Less for other goods. Businesses cut jobs. Unemployment surges. Governments borrow for war, aid. Debt mounts. Interest eats budgets. Bonds demand higher rates. Defaults occur. Stocks fall as profits vanish. Pensions lose value. Retirees sell. Banks face energy defaults. Reserves drain. Credit tightens. Small firms fail. Big ones lay off. Trade slows. Ports avoid Gulf. Container rates double. Goods pile up.
Let's summarize our debate. Participants debated whether a prolonged Iran war, especially a closure of the Strait of Hormuz, could trigger a global financial crisis. They argued that large oil price spikes would drive inflation, demand destruction, and recessions, disrupt shipping, trade finance, and supply chains, stress banks, insurers, clearinghouses, and sovereign corporate debt, prompt capital flight and currency crises in emerging markets, and create nonlinear feedback loops of margin calls, asset sales, and credit tightening that could escalate into systemic financial instability. This debate has concluded. Thank you for watching.